Hey, my name is Amna, and you're watching Amna Unfiltered. Today, I'm about to share some insider knowledge that can completely change the way you approach trading. Whether you're a beginner, a seasoned investor, or someone who just dabbles in the stock market, we all know how unpredictable it can be. One minute, the market is soaring, and the next, it's crashing. You're either hitting the jackpot or watching your portfolio take a nosedive. So how do some traders seem to always come out on top while others just can't catch a break? Well, it's not about luck. It's about mastering the game with rules that work. In fact, today, we're going to break down the top 5 rules for successful trading, strategies that could drastically shift your approach and put you in the driver's seat of your financial future. Trust me, this isn't about some quick get-rich scheme. It's about setting yourself up with long-term sustainable strategies that will help you stay on course even when the road gets bumpy. Now, picture this. You're sitting at your computer, looking at the market, and it's a sea of green and red. You've got all the tools, charts, reports, and some sound advice from others in the trading world. But as you click on that buy button, something inside you starts to feel uneasy. You remember hearing about the market crashes, the people who lost everything because they didn't stick to their strategy. You think about how risky it is, how vulnerable you feel, and how your emotions are starting to get the best of you. Does this sound familiar? It's easy to get lost in the noise, especially when the market's moving fast. But here's the thing, trading successfully isn't about reacting impulsively to every market movement. It's about being prepared, knowing your limits, and having a solid plan in place, no matter what's happening around you. Let me tell you something I've learned over the years. Trading isn't about making one big score or riding the highs of a single great trade. It's about developing habits, discipline, and consistency. Without a plan, without structure, you're simply gambling, throwing darts and hoping they hit the bullseye. But with a strategy, you're setting yourself up to win in the long run, even when things don't go your way. And the best part, you don't have to be a genius or have a PhD in finance to succeed. All you need are these 5 core rules, and trust me, if you stick to them, you'll see significant improvements in how you approach trading and investing. Let's break it down with a real-world example. You've probably heard of a trader who made a fortune in the stock market, right? Maybe they jumped in during the right time and rode the wave of a hot stock. They are living the dream, buying expensive cars, traveling to exotic places, and enjoying the high life. But here's the thing. These are the exceptions, not the rule. For every person who made it big, there are 1,000 others who got wiped out because they didn't follow the right approach. They didn't understand that trading is a marathon, not a sprint. The reality is that trading requires discipline. It requires you to control your impulses, avoid chasing after quick profits, and most importantly, stay focused on the bigger picture. So many people think the key to success in trading is picking the next big thing, the stock that's about to explode. But in reality, it's about patience, consistency, and mastering the basics. It's about creating a strategy that works for you and sticking to it, regardless of the market's fluctuations. So what do these successful traders know that others don't? Why do they seem to always be on top of their game while others struggle to even break even? Well, successful traders don't leave things to chance. They have a plan, they have rules, and they stick to those rules, no matter how tempting it might be to chase after short-term gains or react emotionally to market movements. The first rule: develop a solid trading plan. Without a plan, you're setting yourself up for failure. It's like driving without a map. You have no clear direction. A solid plan is about having specific goals, setting boundaries on how much risk you're willing to take, and sticking to an approach that fits your personality and lifestyle. It's about being realistic with your expectations and having a clear understanding of your risk tolerance. Next, risk management is key. You've probably heard the saying, don't put all your eggs in one basket. And when it comes to trading, that couldn't be more true. Successful traders know that they should never risk more than a small portion of their capital on any one trade. You must always have a plan to protect your capital, especially in volatile markets. This is where things like stop-loss orders come into play. It's not about betting it all on one move, but about making calculated, thoughtful decisions that allow you to take advantage of opportunities without exposing yourself to unnecessary risk. Then there's emotional control. One of the biggest mistakes traders make is letting their emotions drive their decisions. They get excited by a big win and overcommit, or they panic after a loss and make irrational choices. Successful traders know how to check their emotions at the door. They have the discipline to stick to their plan, even when the market is moving fast, or when it seems like there's a lot of hype around a particular stock. They understand that emotions cloud judgment, and they keep their cool to make decisions based on logic, not fear or greed. And finally, continuous learning and adaptation is crucial. The markets are always changing, and no strategy is perfect. That's why the most successful traders are those who constantly review their performance, learn from their mistakes, and adapt their approach. They understand that trading is not a set-it-and-forget-it game. It's an ongoing process of self-improvement and fine-tuning their methods. And if you want to be successful, you'll need to do the same. The more you learn and evolve as a trader, the better your chances of succeeding in the long run. Let me give you another example. Imagine you've been in the market for a while, but things aren't going well. You've experienced losses, and you're starting to doubt whether this is the right path for you. But then you remember the rules, the trading plan, risk management, emotional control, and the importance of learning. You sit down, re-evaluate your strategy, and start to see where you went wrong. You make adjustments, stick to your plan, and gradually you start to see positive results. It's not about perfection. It's about persistence and consistency, and that's what separates successful traders from those who give up too soon. By following these rules, you'll create a strong foundation for yourself, one that allows you to approach trading with confidence and clarity, and sure, you'll still experience losses and setbacks. That's part of the journey. But with a solid strategy, you'll be able to navigate those challenges and keep moving forward toward your goals. Develop a solid trading plan. In the world of trading, there's one rule that stands above the rest. Success is not achieved by chance, but by careful planning. You might have heard it 1,000 times before, but when it comes to trading, a solid trading plan is truly the foundation of everything that follows. Without a plan, you're essentially navigating the markets blindfolded, reacting to every fluctuation and relying on luck rather than strategy. And let's face it, in an arena as unpredictable and volatile as trading, luck simply doesn't cut it. A solid plan isn't just a luxury. It's an absolute necessity if you want to trade successfully and consistently. And here's why. The first thing to understand is that a trading plan is much more than a vague set of instructions or a loose idea about what you hope to achieve. A truly solid trading plan is a comprehensive blueprint detailing every aspect of your trading approach, from the goals you wish to accomplish to the specific strategies and tactics you'll use to reach them. It's a document that provides structure, clarity, and discipline, ensuring that you stay focused on your path, no matter how chaotic or overwhelming the markets may seem. Let's start with goal setting, which is arguably the most critical step in developing a trading plan. Before you can dive into the markets and start buying and selling, you need to ask yourself, what do I want to achieve? Setting clear, specific, and measurable goals is the key to providing direction for your trading activities. It's like trying to navigate from one city to another without a map. You need to know exactly where you're going before you can figure out the best route to take. Your goals may range from a simple, modest profit target to more complex objectives like building long-term wealth or developing expertise in a particular market or asset class. What's equally important as setting goals is ensuring that these goals are realistic, It's easy to get swept up in the excitement of trading and set overly ambitious targets, but this often leads to disappointment and frustration when things don't go as planned. The market isn't a magic trick, and it doesn't always perform according to our expectations. The most successful traders set goals that are both challenging and achievable, understanding that trading is a marathon, not a sprint. It's better to aim for smaller, consistent profits that add up over time than to shoot for the moon with the hope that one big trade will solve all your problems. Realistic goal setting also involves considering the time frame you have in mind, whether you're looking to achieve short-term gains through day trading or playing the long game with buy and hold strategies. Once your goals are clear and achievable, the next crucial aspect of your trading plan is determining your risk tolerance. Trading inherently involves risk, and understanding how much risk you're willing to take is vital to your long-term success. Risk tolerance varies from person to person, and it's essential to honestly assess how much risk you are comfortable with, both financially and emotionally. Your risk tolerance is the foundation for all of your trading decisions, from how much money you put into a trade to how much you're willing to lose before calling it quits. If you're risk-averse and don't like to see significant fluctuations in your account balance, then high-risk, high-reward trades may not be the best approach for you. On the other hand, if you have a higher risk appetite, you might feel more comfortable with volatile assets or larger position sizes. Determining your risk tolerance is not just about setting a percentage for how much of your portfolio you're willing to risk on each trade. It's about understanding how much you're psychologically prepared to lose before it starts to affect your decision-making. Emotional reactions like fear, anxiety, or greed can undermine your ability to stick to your trading plan. So it's essential to have a firm grasp on what you can handle. This is why many successful traders use position sizing and stop-loss orders to manage risk. They have a clear understanding of how much they are willing to lose before they exit a trade, and they stick to that no matter what. This approach helps keep emotions in check and ensures that no single trade can wipe out your account or throw you off course. The next component of your trading plan is developing entry and exit strategies. A solid trading plan doesn't just tell you when to enter a trade, it also provides specific rules about when to exit. Far too often, traders make the mistake of entering a position without a clear exit strategy, only to watch the market reverse and lose their profits. Or, on the flip side, they might let their emotions cloud their judgment and hold on to a losing trade for too long, hoping it will turn around. Having predefined exit points, both for profits and losses, is essential for maintaining discipline and objectivity. Your entry strategy will vary depending on the type of trading you're doing, whether it's day trading, swing trading, or long-term investing. For example, some traders rely on technical indicators such as moving averages to identify when to enter a trade, while others may use fundamental analysis to pick stocks based on company performance and market conditions. Whatever your method, it's essential to have a set of criteria that tell you when the conditions are right for a trade, and these criteria should be specific and repeatable. No gut feelings or emotional decisions involved. Your entry strategy should be based on sound analysis and data that you can rely on to guide your actions. Equally important is your exit strategy, which involves deciding when to take profits or cut losses. This is where many traders go wrong, as emotions tend to take over. A solid exit plan allows you to lock in profits at predefined levels, taking the emotion out of the equation. This might mean setting a price target at which you'll sell once the trade reaches a certain value, or it could involve using a trailing stop to lock in profits as the market moves in your favor. On the flip side, an exit strategy also includes knowing when to cut your losses. Many traders hold on to losing positions too long, hoping for a turnaround that never comes, and ultimately lose more than they should. A well-constructed exit strategy helps prevent this by defining clear points at which you will close a losing trade to avoid further damage to your portfolio. Setting these rules in advance removes the emotional component from trading decisions, allowing you to act with discipline rather than fear or greed. One of the most powerful aspects of a solid trading plan is how it reduces emotional decision-making. Emotions are one of the biggest threats to successful trading, and they often lead to impulsive decisions that undermine long-term profitability. Fear can cause you to pull out of a trade too early, while greed can lead you to hold onto a position for too long, hoping for an even bigger gain. Overconfidence might make you take on excessive risk, and panic can lead to making rash decisions that you later regret. A trading plan combats these emotions by giving you a structured, disciplined approach that you can rely on no matter what's happening in the market. With a solid plan in place, you're not just reacting to the market, you're responding with intention. A well-crafted plan helps you stay focused on your long-term goals and ensures that you're making decisions based on logic, not emotion. When you have rules in place for when to enter, exit, and manage risk, you're more likely to stick to your plan, even when the market feels unpredictable or overwhelming. This is the difference between successful traders and those who chase after short-term gains or make emotional decisions based on market noise. Having a clear plan allows you to remain calm and rational, knowing that you have a strategy that can help you navigate both gains and losses. In conclusion, a solid trading plan is the foundation of success in trading. It helps you set clear goals, understand your risk tolerance, establish specific entry and exit points, and most importantly, it keeps you disciplined in the face of market uncertainty. It's not about luck or blindly following trends. It's about creating a strategy that works for you, sticking to it, and adapting as needed. The best traders are the ones who approach the market with a clear plan, remaining focused on their long-term goals, and staying level-headed even when emotions threaten to take over. So if you want to succeed in trading, start with the fundamentals. Develop a solid trading plan, follow it with discipline, and trust the process. With time, patience, and consistency, you'll be on the road to becoming a successful, confident trader. Risk management is key. In the world of trading, there's a principle that resonates through every successful strategy, one that is as vital to long-term prosperity as the trades themselves: risk management. It doesn't matter if you're trading stocks, Forex, commodities, or cryptocurrencies, the fundamental truth remains the same. If you don't manage risk effectively, you're essentially gambling, no matter how sophisticated your trading strategies may seem. Without risk management, the markets can easily become a fast-track route to financial ruin, no matter how skilled you are at spotting trends or interpreting charts. Successful traders know this instinctively and make it a priority to protect their capital at all costs. Risk management isn't just about limiting losses. It's about preserving the longevity of your trading journey. You might have heard the saying, the goal of trading is not to make money, but to avoid losing money. While it might sound overly simplistic, the truth behind this statement holds substantial weight. It's easy to get caught up in the excitement of making big profits, but when you lose sight of how much you're willing to risk in pursuit of those profits, things can quickly spiral out of control. The key to success in trading lies in minimizing losses, understanding the inherent risks of each trade, and having a strategy in place to protect yourself from unforeseen events that can trigger significant downturns. First and foremost, one of the core tenets of risk management is ensuring that you never risk more than a small percentage of your capital on a single trade. This is often referred to as the 1% rule, but the concept can be adapted to suit your risk tolerance and trading style. The 1% rule suggests that you should never risk more than 1% of your total capital on any single trade. For instance, if you have a $10,000 trading account, You should never risk more than $100 on any one trade. By doing so, even if a trade goes against you, you're not going to blow up your entire account. This small, consistent risk on each trade is a vital safety net that allows you to weather the inevitable ups and downs of the market. The idea of risking only a small portion of your capital might feel like you're not maximizing your potential returns, but in reality, this approach ensures that you're able to trade for the long haul, even when faced with a string of losses. Consistency is the key, not wild, high-risk gambles that can lead to unpredictable and severe losses. Over time, you'll find that managing risk becomes less about trying to hit big home runs and more about ensuring your survival in the market. Every great trader understands that even the best strategies are not foolproof, and one bad decision can wipe out weeks or even months of profits. By minimizing your risk on each trade, you're ensuring that no single loss can derail your trading journey. Another crucial element of risk management is using stop-loss orders. These orders are a trader's best friend when it comes to protecting themselves from significant losses. A stop-loss order is a predefined order that instructs your broker to exit a trade once the price reaches a certain level, which you set in advance. The idea behind using stop losses is simple. By establishing a maximum acceptable loss before entering a trade, you ensure that emotions don't come into play when the market starts moving against you. You set your parameters, you stick to them, and you let the market do its thing, rather than letting panic or hope cloud your judgment. For example, let's say you're in a trade with a $1,000 position size, and you're comfortable risking $50 on the trade. You can place a stop-loss order at a price level that would trigger a $50 loss if the market moves against you. If the market hits that level, your position automatically closes, and you're out of the trade without any further emotional stress or potential for bigger losses. You didn't have to watch the market like a hawk, constantly second-guessing your decision because the stop-loss was already in place, providing an automatic safeguard. For many traders, using stop-loss orders is a fundamental risk management tool that helps prevent catastrophic losses and ensures they stay in the game long-term. Of course, stop-loss orders are not perfect, and there's always a risk of slippage when the market price moves too quickly and your stop-loss order doesn't get executed at the price you expected. However, when used in conjunction with other risk management tools, stop losses still offer an invaluable layer of protection, especially in volatile markets. In addition, you can use trailing stops to lock in profits as the market moves in your favor. A trailing stop moves with the market, allowing you to exit the trade when it reverses by a certain amount, but only after the market has moved in the direction of your trade, ensuring that profits are preserved as you ride the trend. Another highly effective risk management technique is diversification. The idea behind diversification is simple. Spread your risk across a variety of different assets or asset classes so that if one market takes a downturn, your entire portfolio doesn't suffer. In traditional investing, diversification often means holding a mix of stocks, bonds, and real estate. In trading, it means spreading your capital across different instruments such as stocks, commodities, currencies, and even cryptocurrencies. By doing so, you avoid putting all of your eggs in one basket, which could leave you exposed to significant losses if a single trade or sector moves unfavorably. Diversification can also apply to the types of trading strategies you employ. For example, you might decide to mix day trading, swing trading, and position trading within your portfolio, each with a different risk profile and time horizon. By combining these strategies, you're reducing your exposure to any one style of trading, which gives you the flexibility to adjust depending on market conditions. For example, if the stock market is volatile, but the Forex market is stable, you can shift your focus to Forex trading and reduce your exposure to equities. Diversification helps you balance the risks in your portfolio and ensures that you're not overly reliant on any single trade or asset. Another critical component of risk management is controlling position sizes. Many traders make the mistake of putting too much money into one trade in the hopes of making a significant return, but this can backfire quickly if the trade doesn't go as planned. The key to controlling position sizes is determining how much of your capital you're willing to risk on any given trade and adjusting the size of your positions accordingly. Position size is directly tied to your risk tolerance, so it's essential to calculate it carefully based on the distance between your entry point and stop loss order and the size of your trading account. Let's say you're trading with a $10,000 account and you're comfortable risking 2% of your capital per trade. That means you're willing to risk $200 per trade. If your stop loss is 10 pips away from your entry point, you can adjust your position size so that a 10 pip move would result in a $200 loss. By controlling your position size, you ensure that you're never risking more than you can afford to lose, and you're maintaining consistency in your risk management approach. In addition to controlling position sizes, risk-to-reward ratios also play a critical role in effective risk management. Every trade should have a predefined risk-to-reward ratio, which helps you assess whether the potential reward justifies the risk involved. For example, a common risk-to-reward ratio used by traders is 103, which means you're willing to risk $100 to make $300. By using this ratio, you're ensuring that over time your wins outweigh your losses. Even if you don't win every single trade, the goal of risk management is to develop a strategy that provides more opportunities for gains than losses, and the risk-reward ratio is one of the most effective ways to quantify that balance. Stay informed and educated. One of the most powerful and often overlooked aspects of trading is the continuous pursuit of knowledge. Staying informed and educated is not just a suggestion, but a fundamental pillar of success in the trading world, especially when markets are unpredictable, volatile, and constantly shifting. Knowledge isn't just about understanding charts, reading technical indicators, or analyzing trends. It's about being aware of the broader economic forces that impact the markets, understanding the intricacies of different trading strategies, and staying up to date with global events that can dramatically alter market sentiment. If you want to be a successful trader, you must embrace the fact that learning is a lifelong journey in this space. Whether you're a novice just starting out or a seasoned trader with years of experience, the first key to understanding how staying informed can make a difference is recognizing that markets don't exist in isolation. They are deeply connected to global economic conditions, political shifts, and societal changes. For instance, major economic reports such as GDP growth, employment figures, inflation rates, or consumer spending all have the potential to move the markets significantly. A trader who is aware of these economic developments and understands their implications can make more informed decisions rather than blindly reacting to market fluctuations. It's not just about reading the financial headlines, it's about understanding the bigger picture. A solid grasp of economic news and trends can provide critical insights into how the market is likely to behave. For example, if you know that a central bank, such as the Federal Reserve, is planning to raise interest rates, you can anticipate potential market movements in certain sectors like banking or real estate. Similarly, a political event like a change in leadership, a trade agreement, or a natural disaster can have an immediate and dramatic impact on market sentiment. Traders who keep up with such events are better equipped to adapt to these changes, position themselves correctly, and identify opportunities before they become widely apparent. Being informed about global events is also crucial. We live in a highly interconnected world where financial markets in one part of the globe can affect those in another. For example, If there is political instability in a key oil-producing country, the price of oil could rise, which could affect everything from transportation costs to the stock prices of energy companies. Likewise, if a country is facing a recession or a currency crisis, the value of its currency could drop, impacting Forex markets and possibly other global markets. By understanding the relationship between different economic and political events and the markets, traders can develop a broader view of market conditions, allowing them to spot emerging trends before they become widespread. Now let's consider the importance of technical analysis in the trading world. Technical analysis is the study of past price movements, chart patterns, and market data to forecast future price action. While there are many tools and strategies involved in technical analysis, the most important thing to remember is that patterns and trends repeat themselves. The key to mastering technical analysis is staying up to date with these patterns and learning how to recognize them quickly. Successful traders constantly analyze charts, looking for signals that indicate potential trends or price movements. They know that technical analysis isn't about predicting the future with 100% accuracy. It's about spotting patterns that have historically led to profitable trades. Understanding indicators like moving averages, relative strength index, RSI, Fibonacci retracements, and candlestick patterns can give you a significant edge when navigating the complexities of market behavior. However, these tools are only useful if you understand the context in which they're being applied. For example, a moving average crossover may be an indicator of a bullish market, but if you don't understand the broader market trend or ignore key economic data, you might miss the bigger picture. A knowledgeable trader doesn't rely solely on technical analysis. They incorporate it with a comprehensive understanding of current events, market sentiment, and their personal trading strategy. Market sentiment is another powerful force in trading, one that often drives the market more than actual fundamentals or technical indicators. Sentiment refers to the overall mood or attitude of investors toward a particular asset or the market as a whole. It's influenced by a variety of factors, including economic data, corporate earnings, geopolitical events, and even social media trends. Traders who understand market sentiment can make better decisions by gauging whether a market is in a bullish, rising, or bearish state and positioning themselves accordingly. Sometimes sentiment can be driven by irrational emotions or collective behaviors, as we've seen in major market rallies or crashes. For instance, the 2008 financial crisis was partially fueled by a widespread loss of confidence in the financial system, even though the underlying fundamentals did not fully justify the level of panic that ensued. Similarly, markets can experience periods of euphoria, where prices inflate far beyond their intrinsic value due to optimism or hype, only to later correct when reality sets in. Traders who understand sentiment know how to take advantage of these situations, either by riding the wave when sentiment is strong or avoiding overexposure when market psychology starts to turn negative. One of the best ways to stay informed is to immerse yourself in continuous learning. This doesn't mean just reading books or watching tutorials, although that's a good start. It's about staying engaged with the market every day, constantly absorbing new information and being open to evolving your strategies. Reading financial news, subscribing to market analysis reports, and following trusted sources on social media are all ways to stay in the loop. Beyond just keeping track of news, successful traders take the time to actively reflect on what they're learning and apply it to their trades. Having a mentor or joining a community of like-minded traders can also accelerate the learning process. Mentors can help guide you through the ups and downs of trading, offering advice, sharing insights, and teaching valuable lessons learned from their own experiences. A trading community, whether online or in person, can also provide a sense of camaraderie and accountability, giving you access to a wealth of knowledge and helping you stay informed through shared insights and discussions. It's an environment where you can learn from others' successes and failures, refine your strategies, and stay motivated through the inevitable tough times. Furthermore, in today's fast-paced, digitally connected world, real-time information is key to staying ahead of the curve. Technology plays a massive role in ensuring that traders can make quick, informed decisions. Advanced charting software, economic calendars, automated trading tools, and news feeds allow traders to access critical data on the go without having to be glued to their computers all day. This accessibility enables traders to react swiftly to changing market conditions, reducing the chances of missing out on potential opportunities. But even with all the tools, resources, and technology available, one of the most powerful assets you can have as a trader is patience. Knowing when to act, and just as importantly, when not to act, is one of the key components of successful trading. The most informed and educated traders are those who recognize that they don't need to trade every moment of every day. They understand that waiting for the right opportunities, those backed by strong data, technical indicators, and sentiment analysis, is often the best approach. It's tempting to dive into a trade when you feel the pressure of missing out. But the most successful traders are the ones who wait for the right moment and trust their strategy. Ultimately, staying informed and educated is not just about knowing the how-to of trading. It's about cultivating a mindset that embraces continuous growth and adaptability. The markets are ever evolving, and the most successful traders are those who never stop learning. They stay curious, they stay disciplined, and they remain open to new strategies, insights, and tools that can improve their trading outcomes. By committing to this mindset of lifelong learning, you'll be better positioned to adapt to changes in the market, make well-informed decisions, and consistently find opportunities that others may overlook. In conclusion, being informed and educated about the markets is the bedrock upon which all successful trading strategies are built. It's not enough to rely on gut instinct or hearsay. You must constantly educate yourself about the markets, economic news, technical analysis, and market sentiment to make decisions based on knowledge rather than impulse. In a fast-paced world where every trade counts, staying ahead of the curve and being prepared for every market shift can provide the edge needed to succeed. With the right mindset, the discipline to continuously learn, and the tools to stay informed, you will be equipped to navigate the volatility of the markets, making confident strategic decisions that lead to long-term success. Control your emotions. In the fast-paced world of trading, one of the most critical factors that determines success or failure is emotional control. While many traders focus on technical analysis, charts, or market trends, they often overlook one of the most powerful forces at play: emotions. Fear and greed in particular are two of the most dangerous emotions that can cloud judgment, leading traders to make impulsive decisions that are ultimately detrimental to their long-term success. Trading isn't just about making informed, logical decisions. It's about maintaining a disciplined mindset and not letting emotions drive your actions. In fact, it's the emotional reactions, often triggered by the highs and lows of the market, that can lead to significant losses if left unchecked. It is the ability to control these emotions and stick to your plan that separates successful traders from those who constantly find themselves on the losing side. The first emotion that many traders struggle with is fear. Fear in trading often manifests itself in different ways, but the most common form is the fear of loss. It's natural to feel apprehensive when entering a trade. After all, every trade carries some level of risk. But when fear starts to dominate your thinking, it can prevent you from making rational decisions. Fear might make you hesitate at the wrong moment, causing you to miss out on a great opportunity. Or it might lead you to exit a position prematurely because you're worried about a potential loss, even when the trade is still valid. Fear can also cause you to chase losses, selling a position too early in the hope of avoiding further decline, only to watch the market recover and regret your decision later. This fear-based decision-making is detrimental because it's driven by the desire to avoid loss rather than the desire to pursue profits through well-thought-out strategies. The key to overcoming fear is confidence, not in the market, but in your trading plan. Traders who lack confidence are more likely to let fear take control of their decisions. They might overthink every move, second-guess themselves, or be quick to pull out of trades at the first sign of a minor loss. But those who have a solid trading plan, who have tested and refined their strategy, can trust that their analysis is sound. Confidence comes from preparation, from knowing that you've done your homework and that you're executing trades based on logical reasoning, not emotional impulses. Having a pre-established entry and exit strategy allows you to maintain control of your emotions because you have a clear roadmap of how you intend to navigate the trade, regardless of what happens during the trade's progression. Fear of missing out, also known as FOMO, can also be incredibly damaging. FOMO occurs when a trader sees the market moving in a direction and feels an overwhelming need to jump in, even if the timing or conditions aren't right. FOMO often leads to impulsive, poorly timed trades that can result in significant losses. This emotional reaction is fueled by the desire to catch every opportunity, to capitalize on every upward move, and to avoid feeling left behind. However, giving in to FOMO means deviating from your well-thought-out plan and entering trades without proper analysis or strategy, which is a surefire way to set yourself up for failure. The key to overcoming FOMO is recognizing that the market will always offer opportunities. There is no need to chase after every price movement. There will always be another trade. Successful traders know how to sit patiently and wait for the right setup according to their strategy, rather than acting on emotional impulses. The second emotion that often leads traders astray is greed. Greed is equally dangerous, if not more so, because it can lead traders to make decisions that are based on unrealistic expectations or the desire to achieve quick profits. Greed often manifests itself when traders find themselves in a winning position and the desire to make even more money clouds their judgment. It's easy to get caught up in the excitement of a winning trade, to think that you're on a roll and that the market will continue to move in your favor. But when greed takes hold, traders might increase their position size, hold on to a trade for longer than necessary, or even take unnecessary risks in an attempt to maximize their profits. This is the mindset that leads to overtrading, taking on more risk than is warranted, and failing to exit a trade at an appropriate time. Greed can also lead to chasing after unrealistic targets. For example, when a trade is performing well, a trader might think, if I can just hold on a little longer, I can make so much more money. But the market is inherently unpredictable, and holding on too long out of greed often results in a reversal, turning a profitable trade into a loss. The temptation to keep riding the market upward to get in on the next big thing without rational analysis can be incredibly powerful, but it often leads to disaster. The best way to keep greed in check is to have clearly defined profit-taking points or exit strategies that are grounded in your overall risk-reward ratio. Traders who understand that gains should be locked in at a reasonable level and who are willing to take profits when the market hits their target are more likely to remain disciplined and avoid the dangerous trap of greed. The ability to control emotions is closely tied to the concept of discipline. Discipline is perhaps the most important trait a trader can possess. Trading is not about excitement, chasing thrills, or making impulsive decisions. It's about consistently following a plan and sticking to the rules you've set for yourself. A disciplined mindset involves not only sticking to your trading plan, but also exercising restraint and patience. This means avoiding the temptation to enter a trade out of boredom or to engage in overtrading. Overtrading often occurs when traders let emotions like excitement or the desire to make up for previous losses take control, and they start executing more trades than are necessary or aligned with their strategy. Successful traders understand that trading isn't about making as many trades as possible. It's about making smart, calculated decisions based on their analysis. When a trader is disciplined, they have the patience to wait for the right opportunities, and they know how to manage their emotions when those opportunities arise. They resist the urge to chase the market and stick to their plan even when the market is volatile or when they're experiencing a run of losses. Discipline requires consistency, the ability to take the same approach over and over again without being swayed by fleeting market conditions or emotional highs and lows. When emotions take the wheel, impulsive decisions are often the result. It's incredibly easy to let emotions influence trading decisions, especially when the market moves quickly or when you're seeing large gains or losses. In these moments, it can feel like the best course of action is to act fast, to jump in, or to pull out of a trade to lock in your profits. But this is when a trader's mental fortitude is tested, and the ability to stick to a plan is the true mark of success. To avoid impulsive decisions, a successful trader develops a clear strategy that includes specific guidelines for entering and exiting trades, managing risk, and staying patient. This removes the need to make spur-of-the-moment decisions based on market fluctuations, and instead the trader is able to follow their plan, even when emotions are urging them to act. Another tool for managing emotions is journaling. Keeping a trading journal allows traders to reflect on their trades, to document the emotions they felt during those trades, and to learn from their experiences. Writing down thoughts and observations after each trade helps a trader stay mindful of their emotional triggers, and it can serve as a valuable tool for identifying patterns of behavior that lead to mistakes. For instance, if a trader notices that they tend to make rash decisions when they're feeling overly confident or fearful, they can consciously work on addressing those emotions in future trades. Journaling offers clarity and allows traders to develop greater emotional intelligence over time. The bottom line is that trading is not a game of luck or instant gratification. It's about staying grounded in a strategy, maintaining discipline, and understanding that losses are part of the process. A trader who is emotionally controlled will be able to take losses in stride without letting them snowball into a series of impulsive decisions. Similarly, a trader who manages their greed will avoid the temptation to let a winning trade turn into a losing one out of the desire for more. Emotional control doesn't come overnight. It takes practice, self-awareness, and a commitment to sticking to a well-defined plan. The best traders are those who can maintain a calm, disciplined mindset, even in the face of extreme market volatility. In conclusion, emotional control is the cornerstone of successful trading. Traders who can manage fear and greed, who can remain disciplined in the face of excitement or uncertainty, and who consistently follow a plan are the ones who thrive over the long term. Trading is about making rational, informed decisions, not about letting emotions take over and dictate your actions. By developing the discipline to stick to your strategy, practicing emotional awareness, and consistently reflecting on your decisions, you can ensure that you stay on course, avoid unnecessary risks, and, most importantly, protect your capital while pursuing your trading goals. Review and learn from your trades. In the world of trading, every move you make, every position you take, and every decision you make in the market contributes to your growth as a trader. Whether you come out on top or face losses, each trade offers invaluable lessons that can shape your journey, but only if you take the time to review and learn from your trades. Successful traders don't just trade and forget. They take the time to reflect, analyze, and refine their strategies based on their experiences. This continuous evaluation and adaptation process is what separates those who succeed in the long run from those who fall victim to the unpredictable nature of the market. The truth is, without a structured method for reviewing your trades, you'll miss out on key opportunities for improvement and you risk repeating the same mistakes again and again, often at the cost of your trading capital. The concept of regularly reviewing your trades may seem like a simple one, but it is one of the most powerful tools in a trader's arsenal. By reflecting on past decisions, traders can uncover patterns, identify weaknesses, and fine-tune their approaches, ultimately becoming more adept at reading the market and responding strategically. However, this review process is not just about looking back at your wins and losses and patting yourself on the back or feeling disappointed in your mistakes. It's about taking an honest, objective look at each trade and learning from every aspect whether the trade was successful or not. Successful traders approach their trades with a mindset that values learning from both their triumphs and their failures, as each offers valuable insight into how they can improve and refine their strategies going forward. When you review your successful trades, you're not simply looking at the outcome, but you're also reflecting on the strategies and decisions that led to that success. You're asking yourself questions like, what was my rationale for entering the trade? How did I determine the right entry point? What indicators or patterns did I use to make my decision? Was I patient? And did I stick to my plan? By analyzing what went right, you gain a deeper understanding of the strategies that worked, and you can look for patterns that can be applied to future trades. Did you wait for confirmation of a trend before entering, or did you jump in too early? Did your risk management strategy work as intended, or did you find yourself overexposed to a single trade? By answering these questions, you can identify the strengths of your strategy and what you should continue to incorporate into your future decisions. However, equally important is reflecting on your unsuccessful trades. It's easy to want to forget about the trades that didn't work out the way you hoped. But the truth is, these are often the most important ones to review. Losses can be difficult to face, especially when they feel like a blow to your ego, but they offer invaluable lessons that are essential for your growth as a trader. When you experience a loss, it's important to take a step back and look at what happened, not with judgment or regret, but with the intention of learning. Did you let emotions cloud your judgment, or did you deviate from your trading plan? Was your risk management strategy sufficient, or did you take on more risk than you should have? Were there signals in the market that you missed, or did you fail to adapt to a sudden change in condition? It's important to treat each trade, win or lose, as an opportunity for self-improvement. A loss is only truly a loss if you don't learn from it, and that's where many traders go wrong. They either brush it off, chalking it up to bad luck or market conditions, or they become so fixated on the negative outcome that they fail to see the lessons it offers. The key is to approach both wins and losses with an analytical mindset, recognizing that each trade is a stepping stone towards becoming a better trader. By reviewing unsuccessful trades and identifying the mistakes or miscalculations that led to those losses, you can adjust your approach, make necessary changes to your strategy, and avoid repeating those same mistakes in the future. Tracking your performance is another crucial element of the review process. Successful traders often maintain a trading journal where they document every trade they make, including the reasoning behind the trade, the strategy employed, the outcome, and any other relevant factors. This journal serves as a record of your growth, allowing you to look back at past decisions and analyze the thought process behind them. Over time, it becomes easier to spot patterns in your behavior, such as recurring emotional triggers or common mistakes that you make under certain market conditions. Keeping a detailed record of your trades also helps you recognize when you're straying from your trading plan or when your emotions are influencing your decisions. It serves as a checkpoint for your trading discipline and allows you to recalibrate your approach when needed. Moreover, a trading journal can also serve as a motivational tool, reminding you of the progress you've made and the successes you've achieved along the way. It's easy to get discouraged after a losing streak, but looking back at your journal can remind you that setbacks are part of the journey, and they don't define your ability to succeed in the long run. The journal can also highlight areas of strength that you can build upon, helping you develop confidence and trust in your trading approach. In addition to reviewing individual trades, it's essential to conduct a broader analysis of your overall trading performance. This means taking a step back and evaluating your trading strategy as a whole, looking for any areas that need improvement or adjustment. Perhaps you've been focusing too heavily on one asset class and not diversifying enough. Or maybe you've been taking on more risk than your strategy allows. By reviewing your overall performance, you can identify any trends or imbalances that may be affecting your results, and you can make necessary adjustments to optimize your strategy. While reviewing your past trades is crucial for self-improvement, it's also important to understand that adaptation is key to staying competitive in the markets. Markets are constantly evolving, and strategies that worked well in one market environment might not work as effectively in another. As you continue to trade, you'll gain valuable experience that allows you to adapt to changing market conditions, but only if you are willing to learn and evolve. By continually analyzing your trades, adjusting your strategies, and staying open to new methods and approaches, you can position yourself to take advantage of emerging trends and developments. The process of learning from your trades isn't just about identifying mistakes or improving your strategies. It's also about understanding your own psychological tendencies as a trader. Trading is a psychological game as much as it is a strategic one, and the emotional aspects of trading can often have a bigger impact on your success than your technical skills. By reviewing your trades, you can begin to understand how emotions like fear, greed, impatience, or overconfidence influence your decisions, and you can develop strategies to counteract these tendencies. For example, if you find that you tend to get emotional after a series of losses and then make impulsive trades, you can develop techniques to calm your mind and regain focus. If you tend to hold on to winning trades for too long out of greed, you can set clearer exit strategies to take profits at predefined levels. Understanding your psychology and incorporating mental discipline into your trading plan is just as important as mastering technical analysis or risk management. Moreover, continuous evaluation is key to keeping your trading strategy fresh and effective. Trading is a constantly evolving process, and the more you trade, the more you learn about yourself, the markets, and your approach. The best traders never stop learning. They read, they adapt, and they look for ways to improve their strategies over time. By reviewing your trades regularly, you ensure that your approach evolves with the markets and with your own growth as a trader. This adaptability is what allows traders to maintain consistent success over the long run, rather than relying on outdated methods that no longer serve them. As you review your trades, it's also important to embrace failure as part of the learning process. Failure in trading is inevitable. No trader wins 100% of the time, and there will always be losses along the way. The key is to use these failures as opportunities for growth rather than letting them discourage you. Each loss is an opportunity to learn more about the market, your strategy, and your emotional responses. By analyzing your failures and learning from them, you increase your chances of success in the future. The best traders aren't those who avoid failure, but those who embrace it, learn from it, and use it to build better strategies moving forward. In conclusion, regularly reviewing your trades is essential for continuous improvement in trading. Whether your trades are successful or unsuccessful, each one offers valuable lessons that can help you become a better, more disciplined trader. By analyzing both your strengths and weaknesses, tracking your performance, and adapting your strategies accordingly, you create a foundation for long-term success. The process of review and learning is not a one-time activity, but an ongoing journey of self-improvement and adaptation. The best traders are those who are committed to constant learning, who take the time to reflect on their decisions, and who use their experiences to refine their approach. It is through this cycle of review, reflection, and refinement that traders improve their skills, adapt to changing market conditions, and achieve consistent long-term success.